So on Wednesday, the Fed made its move, cutting rates by 25 basis points. The first rate cuts in almost a year, and this could mark the beginning of a major shift in our economy. Since the markets have been digesting the news, things have actually gotten pretty interesting. But I wanted to take a step back today and just reflect on what it all really means and how this could impact both stocks and crypto. Interest rates are really just the price you pay to borrow money. So whenever the Fed goes and cuts interest rates, they're just making it cheaper to borrow money. This makes it easier to get mortgages, small business loans, car loans, and even credit cards. In practice, lower rates encourages more spending and investment. Homeowners can afford a bigger mortgage. Businesses can afford to expand or hire more staff. But there's a trade-off too. If the economy heats up too much, all this spending could really just drive inflation higher. All right, so now let's flip it. What happens whenever the Fed wants to cut rates and cool things off? Whenever the Fed raises rates, the opposite happens. Borrowing just looks less enticing to people, so they'll put off buying a new house or buying a new car. It also means businesses might start scaling back expansion and looking at things a little different. With less spending overall, demands for goods and services starts to fall, leading to a slowdown in inflation. In other words, rate hikes basically just slow the amount of money flowing into our economy, putting brakes on everything. But there's a risk here. If rates are pushed too high for too long, spending can drop sharply, and that can tip us into a recession. It's important to understand that raising or cutting interest rates isn't literally printing more money. It just affects the price of actually borrowing that money. Diving a little deeper, banks borrow from the Fed at an official rate and then lend it to businesses and people at a markup. So whenever the Fed lowers rates, loans become cheaper across the board. The Fed actually does control the money supply, but that's through a process in its balance sheet, and that's a whole different topic. For months, the Fed has been raising rates aggressively, trying to fight post-COVID inflation and bring it back under control. So now inflation has eased, sitting around 3%, which means that the immediate fight isn't as urgent as it was before. But something else has changed. Our labor market is starting to slow down much quicker than we expected. Recent data revisions showed almost 1 million fewer jobs were created in the past year than we originally thought. And the latest job report showed just 22,000 jobs were added. Virtually no growth. At the same time, unemployment has ticked up to 4.3%, the highest it's been in 4 years. We're seeing pressure on both sides. People are struggling to find work, and no jobs are being created. And that's why the Fed made its first cut in almost a year, a 25 basis point reduction. Put simply, the Fed is switching gears because our economy is showing signs of strain. With inflation finally cooling and clear warning signs in our labor market, the Fed is switching its stance. They're trying to emphasize a more neutral, data-driven tone moving forward. Economists are now expecting a slower path of cuts rather than the rapid hikes we saw before. The message is clear. The Fed is still fighting inflation, but they also need to watch our job market. This shift is meant to calm investors worried about a hard landing. But at the same time, it highlights that the economy is really slowing down, and it could be the first step in a broader downturn. So how is this going to affect the market going forward? In general, lower rates are good news for risk assets like stocks and crypto, as cheaper borrowing and more liquidity pushes investors towards higher return opportunities. Still, this move reflects a genuine slowdown in our economy. After 2 years of tightening, the Fed is finally signaling a shift. With growing concerns about our labor market, this could be a whole new chapter. For investors, especially younger ones, this is a critical moment, as lower rates can mean more liquidity and more opportunity. It also means we're entering uncertain territory, where the same easing that's fueling rallies could be a sign of deeper cracks in our economy. The main takeaway? Don't just follow the headlines, because investors who can adapt early, position smartly, and think long term can really turn this moment into an opportunity. I hope I gave y'all just a little bit more understanding of the Fed and how everything works. Thank you so much for watching. Don't forget to like, comment, subscribe, and have a great day. Thank you.